So talking about winners and losers, let's start first of all with the Treasury itself, because they've got auctions coming up. Nomura's out today saying you shouldn't be buying these things. Is the Treasury a loser because they're not going to be able to have people buy their bonds?
Well, of course, it's the complete opposite for borrowers and savers. I mean, the Treasury's really benefited from this low interest rate environment for the past several years. You look at the auctions coming up this week, and it's a really big test of if this sell-off is going to persist that we've seen for the past 2 weeks, or if people are saying, all right, this has gone far enough in a world of low interest rates and we're going to be buying.
And of course, who might be buying? And those indirect bidders, the foreign bidders, really key to this, because the idea is as yields back up, you're going to have foreign investors, those in Europe as well as Japan, come in and buy because now we have the better yields. And the question is, does that thesis actually hold water? Right.
The indirect bidders among the three sort of buyer classes in auctions are going to be the ones to really look for, because the U.S. has really been relying on these foreign buyers over the past several years to sort of step in as primary dealers have less capacity to take down bonds, and the central banks are obviously big foreign as well.
That happened before the spreads, for example, with Bunds on the one hand and JGBs have really blown out in the last week or so.
Right, and I mean, you look at what I like to look at is sort of the hedged yield that you have on U.S. bonds, and you can see that that's really widened out quite a bit. So U.S. Treasuries actually look really attractive on a foreign basis. So it will be interesting to see that indirect bid and whether the foreign buyers come in for this week's auctions.
Brian, how attractive is all of this for the pension funds who need to match their liabilities? Talk to me about the significance of 3% on a US 30-year.
It's very significant. They've been waiting for this for a long time, they tell me. And it's because pension math and the liabilities, the future liabilities, they go down quite a bit when interest rates go up, and the pension funds are able to better match their future liabilities with these bonds that now offer, as you say, 3% interest rates.
Does this have the potential of actually bringing more funds back into the bond market, in the sense that some of the pension funds had to go into sort of more risky assets in order to meet their liabilities?
Right. The idea is that they've had to go into stocks to try to match their yield bogeys, and now that interest rates are going up, what they're able to do is they're able to match and immunize themselves by locking in these longer, higher rates and match their liabilities.
So Brian, we've had a weekend full of talk about 100-year debt coming out of the Treasury. Talk to me about that, because traditionally the Treasury guides its auctions towards what Wall Street wants, which is shorter duration. Why would they change the way they've done things for many years?
Well, the idea was to do really long-term bond sales when you can see all these different countries around the world locking in really low interest rates. But now that yields are backing up, the question is there really this demand for that long duration debt anymore? Because you see the 30 years already gone up half a percentage point just since the election.
Explain to me exactly what the bond market will be likely to do. I mean, specifically to Jonathan's point, the yield on the 30-year has been going up. So if you were going to go into the market with a 100-year, what would that yield look like?
I mean, the interesting thing is the longer you go out, just the way that bond math works. I mean, it's not exactly apples to apples where it's going to be triple the yield on the 30-year. I mean, the yield curve sort of will flatten out. But I mean, you are looking at obviously higher yield than 3%. I mean, maybe like 5, 6. I don't know. That's where Jeff Gundlach sees the 10-year going. So in a few years. So who knows?